Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
What are you going to do when the Condor hits your short strike price? Now, let's say the euro, in that example that we mentioned, the euro goes up to 72, and we're short that 72 call, and we're losing money on that call spread right now. At that point in time, what's your plan? Are you still in a neutral trade when the euro would be at 72, because that's your short strike price? Are you in a neutral trade? Absolutely not. You are not in a neutral trade at all. You're in a bearish trade. And if you're bearish on the euro at that point in time, great. You're in a pretty good position if you're bearish. But if you're neutral and you're just kind of twiddling your thumbs and sweating and wondering what to do, you're not in a neutral trade. You need to either exit the trade or make an adjustment at that point in time. Or just pray that it goes down and goes against what your sentiment is. Those are your choices when that happens. How are you going to adjust? Are you going to turn it into a butterfly trade? Are you going to roll out to the next month? Are you going to change the amount of contracts? What's your plan with what you're going to do? And finally, when is adjusting better than just getting out of the trade? One thing that you do, one thing that I think adjusting is a good thing if it's done with a plan. And this is just me personally. If you over-adjust and turn the trade into a six-legged double butterfly, eight-legged iron condor with 4 or 5 other different things thrown in, then the only one that's going to get rich in the deal is your broker. And if you over-adjust, it's really not the way to go because, like I said, it's probably not right. But if it's going against you, there's no law that says that you're not able to take a stop loss. Living to trade another day is something that's very important. Now, if you have a problem with adjusting, if you're thinking, well, you know what, I think it's going to stay between, the euro's going to stay, the EUI is going to stay between 68 and 72. But you know what, if it goes up to 73 or 74, I think it's going to come back, and I'd like to just let it sit there. What can I do? Well, the way with which you can limit your risk on it is take a smaller position. The beauty of trading currencies is that if you're a long-term bull in the marketplace and you have a problem putting on condors on the stock market, FX options can be a great thing for you because there's not a lot of correlation between the currencies and the U.S. stock market. There are some arguments for that, but for the most part, this is a way with which you can kind of separate yourself if you're an overall long-term bull. That's one of the beauties of this. But the point is, make sure you have a plan as to what you're going to do. This is how we do it. In terms of leverage, with all of our Condor clients, typically we tell people to consider having 75% of the Condor portfolio in cash or cash-like investments. Now, for some people, they may say, well, you know what, that other 75%, I have it working for me in a real estate property. Maybe they have it in a bond. Maybe they have it in something. But with that, we tell people 75% because that way, when you lose, notice I didn't say if, but when you lose and when you're wrong, you have the ability to draw from that other 75% to live to trade another day. That's why we set our proprietary portfolios up that way in terms of the leverage that's involved. Over-leveraging is the greatest risk in all of trading, in our opinion, at Know Your Options. That's something that we stand by, that we encourage people to not do at all, is to over-leverage themselves. Now, what are some adjustments that you can do when trading options or when doing condors? Well, the first one to consider, possibly changing months, meaning that if you are doing an August condor, excuse me, and then maybe volatility just drops. If volatility just drops, then maybe it's time to get out of that August condor and go out to September, because maybe September volatility didn't drop the same way that August did. Or Let's say volatility spikes, and you want to lock in that higher volatility for another month. You can change months that way by making an adjustment that way. Another way with which you can make an adjustment is contract movement and or rolling options. Let's say, for example, that the stock or the currency or whatever instrument you're trading gets close to that short strike price. Well, if the time decays worked in your favor, then you might not be as hurt as you normally would as if it would go right away, or if implied volatility's worked in your favor. You may have that going for you. So this might work for you, but maybe you could, let's say it gets close to the call price, close out some of the puts for profits, maybe tighten up with a tighter put spread with lesser amounts of contracts, and then close out some of the call spreads for a loss. So overall, you'll be netting a break even, or at least you hope anyway, because time decays worked in your favor a little bit, but you're tightening up the Condor. Now, the advantage, you have less contracts on the table. The disadvantage is that you have less wiggle room, so to speak. That's another technique that you may want to consider. I wouldn't recommend doing that per se unless you've done this a few times or you have some experience with that. Perhaps you can create a new trade. There's in SFO magazine recently, there was something on the Mighty Mouse adjustment and the Mickey Mouse adjustment, I think it was. In that case, when it gets closer to the short strike price, what one of the, and I forget if I confuse the Mickey Mouse and the Mighty Mouse, for those of you that read the article, I apologize, but the Mighty Mouse adjustment is that you just, let's say you have a 10-lot Condor on, it starts moving against you, then maybe buy a 1-lot debit call spread inside of the credit spread. It kind of works as a little bit of a hedge in case it continues to go against you. If you want the other one, and I forget which one's Mickey and which one's Mighty, just buy a call option as it gets closer to the call spread. Now let's go back to the presentation and just finish up with a few things, then we'll open it up for questions. Some other thoughts that I want to talk with you about. Leverage. Only the trader, the investor, or the advisor can help you in terms of making a decision on what level of leverage to do. If you go all in and put all your money into a Condor and leverage yourself to the hilt, it'll work great when you're right, but when you're wrong, it's going to hurt, and it's going to hurt bad. Never fear the market, but always respect the market. Now, for some people, they're comfortable with a small level of leverage. I'd be fine with a little bit of leverage. However, understand that it's a calculated risk that needs to be underlined when doing this. What are you going to do when the Condor hits your short strike price? Now, let's say the euro, in that example that we mentioned, the euro goes up to 72, and we're short that 72 call, and we're losing money on that call spread right now. At that point in time, what's your plan? Are you still in a neutral trade when the euro would be at 72, because that's your short strike price? Are you in a neutral trade? Absolutely not. You are not in a neutral trade at all. You're in a bearish trade. And if you're bearish on the euro at that point in time, great. You're in a pretty good position if you're bearish. But if you're neutral and you're just kind of twiddling your thumbs and sweating and wondering what to do, you're not in a neutral trade. You need to either exit the trade or make an adjustment at that point in time. Or just pray that it goes down and goes against what your sentiment is. Those are your choices when that happens.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.